You will never be profitable if you don't understand liquidity. Today we're going to go through some of the best draws on liquidity in the market and how you're going to use them to improve. So the first one we have is data highs and data lows. We actually have a good example of that from today. We had an 8:30 news release. Here's the 8:30 candle. As you can see, we leave a very obvious top wick. That's going to be your data high. Price manipulates lower before getting good momentum back to buy side and taking out the data high, showing that this is an extremely strong draw on liquidity. The next one we have is session highs and session lows. As you can see in this example, London highs are marked out. We end up coming lower before manipulating higher, taking out previous session highs. To get a good reaction from this and get good bearish momentum. After getting bearish momentum, your next draw on liquidity could be the unfilled previous session lows, which in this instance will be London lows. Another good draw on liquidity is going to be equal highs and equal lows. If you don't know what these are by now, you probably should. It's essentially when price comes up and leaves one set of highs, comes back down and leaves another set of highs in the same area without taking them out. These are going to be your equal highs or relative equal highs. Same thing the other way, if it's relative equal lows or equal lows, same thing. Price is likely to revisit this area. You can use this to your advantage and look for potential positions back to buy side here. New week opening gap is another good draw on liquidity in the market. I have a whole video explaining it if you want to check it out more in depth, but it's essentially when markets close on Friday and reopen on Sunday, you're going to have a gap in price. Mark out that gap in price. It's going to be a good key level for the rest of the week and a good draw on liquidity as well. The last and final one I have is volume imbalance. I have a good example of that here too. So it's essentially when the day closes and reopens and you have a imbalance in price. So as you can see here, on the 3rd of February, price ends up closing at 25422, reopens on the 4th of February at 25388. You have a volume imbalance there. Price is going to be drawn to it. As you can see, price comes down, actually taps another volume imbalance before coming up higher and hitting this imbalance, respecting it perfectly and coming back lower. If you ever see these, mark these out. They're going to be useful and good key levels in the market.